Hi, welcome to today's video. Today's video we're going to look at financial statement analysis and all the different aspects of that in general, so you get a general idea of what it is involved. First off, let's look at horizontal analysis. Horizontal analysis looks at changes in accounts on the income statement and balance sheet over time. So if we went from $10 to $15, then there would be a 50% increase from year 1 to year 2. So the base year is always the oldest year in horizontal analysis. So if we started off with 2012 numbers and we're comparing 2013 and 14 to that, 2012 would be 100%, and then the numbers would be higher or lower in 2013 and 14 from that base year amount. Vertical analysis looks at how much each account is as a percentage of total assets on the balance sheet or as a percentage of net sales on the income statement. Gross sales will be over 100% because of sales returns and discounts, which brings it down to 100%, so net sales are 100. Everything is a percentage of that, so your net income might be 1%. So what that would mean is that for every dollar of sales, you're getting 1 cent back in profit. Common size statements let us compare firms of different sizes, but beware that results should be different as size does change as we get bigger. So it does change the relationships. It's easier for, say, a large firm to advertise than it is for a small firm. Yet small firms have advantages over large firms. So some of the numbers, will be a little bit different, so beware size does change certain relationships. And ratio analysis compares items on financial statements. Basically, it's a dollar amount divided by a dollar amount. Now, there may be several items that we're adding up. So, for example, cash, receivables, inventory, and other current assets could be added to get current assets. So, there could be a number of accounts that are being added up for comparison purposes. Seasonality is a factor, so beware when comparing to others. For example, if I wanted to look at any of the ratios with regards to, say, a toy store that books ended in November to one that the books ended in the 1st of February, I would expect big differences, especially in the inventory area, as the first company would be gearing up for Christmas sales and the second one has already had them. So do beware of differences in year ends. Other things to be aware of is different accounting methods or management styles can make comparisons hard. So I use FIFO, you use LIFO. I am aggressive, you are conservative. Those all will play a role in making comparisons a little bit different. And then what about different segments that are owned? That can complicate comparisons as well. Let's say we're an airline and we own a burger firm and we're trying to compare to another airline that owns a bank. We need to get the bank and the burger parts out so that we can compare the airline part of the business to the airline part of the business. So in reality, financial statement analysis, which does look easy, does have some complicating factors. And the math that's involved in the homeworks in this area will be relatively easy, but in real life, they may not be as easy because of these issues that are involved therein. I look forward to seeing you on the next video.